Well, hello and welcome to this version of the Market Wrap. We have seen substantial weakness in our own markets. In fact, the Nifty has fallen substantially well below the mark of 8,000. So, and considering that was a very important level that everyone was watching out for, now we're well away from that. But to make of this mayhem, if I may call it this, I have market expert Mr. Anand Tandon joining us. Thank you, sir, for joining us. And once again, firstly, I want to know what is happening with our markets and how much is this overdone, or can we expect more weakness going forward?
Well, if you look at the immediate 1 or 2 days, we've had a fairly sharp fall, and therefore to some extent the market looks like it's oversold. But make no mistake, I don't think that this selling will necessarily abate, or more importantly, that there is a rebound view immediately. Because one, the market was already significantly overpriced for the most part. And to a large extent, what we have seen is a correction of that. It may have been triggered by any number of events, but the fact is that the market needed correction. The more fundamental issue is this current move of demonetizing currency. Will that materially affect the earning potential of the company, and are we actually looking at yet one more quarter or 2 more quarters of earning downgrade? If that is true, then I think the market is still not correcting.
But considering that, so on at least on the street, we have a few brokerages already downgrading the targets on the Nifty and the Sensex because they are expecting, low GDP growth, of course. They're revising all the numbers with respect to the targets on the GDP and a lot of other economic factors. In your opinion, how much more pain can we expect in, say, over the next couple of quarters?
I don't think we have seen this kind of thing in the past, at least I haven't. And I don't think there are too many parallels of similar size economies. So it is really anybody's guess what we are looking at. I think, there are opposing forces at work here. On the one hand, there is no doubt there is a severe disruption of economic activity, and that can slow down economy quite considerably. On the other hand, I think what you will find is that it will also push some of the unaccounted economy into the accounted economy, and that will be a counterbalancing force. Similarly, if you were to look at the money supply, one of the things that I'm looking at is that, whatever anecdotal evidence you get, there is a serious redistribution of wealth that is going on, because those who are sitting on cash are having to use various means to try and bring it back into the accounting system, and in the process they are having to share a large part of the wealth. So actually speaking, I think there is many of the marginal individuals in the economy will certainly get one-time cash transfer, which will be a bonanza, which can also increase the consumption levels. So I'm not necessarily very sure that it is all bad. Near term, obviously, people are more interested in in how to get over the immediate problem. So for let's say this quarter, for sure, we will have a kind of downgrade. But going forward, if you were to take a 12-month view, I'm not necessarily sure that will be negative. It may actually turn out to be quite reasonably positive, especially if the amount of money that is left with the government, which does not come back, allows the government to actually go out and spend, and they come up with an interesting program to actually go and support economic consumption.
Okay, so Mr. Tandon, from a positional trader who has some, positions and long positions in the market, what does a positional trader do? And for ones who are interested in long-term investments, is this a good time? Should they start nibbling into the stocks, or should they wait for a little while longer before they see some more correction?
So for a longer-term investor, if there is, I would imagine that at any time, if there is enough margin of safety in the particular stock that he is investing in, which is that you take moderate growth expectations, look for moderate valuations, and then leave some upside, some margin for these kind of surprises. If you still think that there is value in the stock, you should go out and buy irrespective of market. For the trader, the challenge is a lot worse because you are looking at, as I said, a situation which is unfamiliar to all of us, and therefore you have to take a bet one way or the other. For them, as I said, near term, next 2-3 days, I wouldn't be very surprised if you see some kind of a pullback, albeit minor. But I don't think that the selling is done yet. I don't see too many stocks which have reached levels where they are a compelling buy, though they are obviously much better positioned today than they were, let's say, even 10 days back.
So in that case, you do not for now see any compelling buys. And in that case, what are those few ideas that you still wait for before you start going into those stocks?
So obviously companies which are not so much domestic oriented continue to remain attractive, and therefore, pharma is one clear bet. Any of the other export companies continue to remain decent. I think, we've had a huge rally in some of these, fine chemicals kind of companies and so on, which have certainly developed a more interesting portfolio. Some of the textile companies which exports will also do well. On the domestic side, one thing is clear, that the government expenditure will continue. So therefore, anything that the government is pushing, whether it is transmission, distribution, and related sectors, or it is road, was already doing well. What you are getting is a chance to buy some of those stocks cheaper, and I think that will provide another area of interest. As I said, I would expect to see the government spend go up quite considerably. So I think that is a sector which will remain protected. If you are willing to buy the argument that the redistribution of wealth will push another cycle of consumption, especially at the margin, then some of the consumer non-discretionary is something that I would look at, bar the fact that the valuations are not at all compelling there.
So based on that, are there 2 or 3 ideas that you'd like to give our audiences, or some ideas that you're waiting on right now?
Well, it's, I don't normally give out companies for the simple reason that, you have the right to change your view, which you cannot convey.
Right.
But I think sectors that I have given up are, many, and many of, even the frontline companies in most of these will do quite well. I think the areas that you need to be careful about are real estate and financials, especially those which have been consumer focused, because A, they are over-owned, 2, overpriced, and 3, they are likely to get hit the most, especially those which have been lending against, let's say, gold loans, or or even NBFCs which have been lending to farm sector, because some of those will actually face some near-term growth issues.
Right. So you have mentioned the financial sector, and once again, in the NBFC space, in that case, how would you work with a housing finance company as against a microfinance company now?
Well, housing finance, you don't expect to see a deterioration in the asset quality in any meaningful way. In microfinance, I think the possibility of deterioration is quite significant. Again, 2 reasons. One, there was already it was an overheated space, both from the point of view of the fact that there were too many players, its size was not as big as most people think it is, and the valuations for most of them was grossly overstretched. We have seen this once before. The last time there was a panic in the microfinance sector, it was largely led by the fact that there was, you had been stopped in one state from recovering money on a daily basis. I think the lack of currency has pretty much done the same, except it is now not restricted to one state. So I would expect to see that, some of those defaults will come through, especially if the microfinance companies don't quickly go out and lend more money to the same people and essentially whitewash the loans.
And finally, Mr. Tandon, there is one other factor which is adding to the market's weakness, that is the foreign institutional investors which are withdrawing funds. What, in your opinion, would they start seeing before they start coming into our markets right now?
Well, that is a more factor of what has happened in the US. Clearly, the fact that the US yields have gone up is bad news for the emerging markets in the near term. I think, a large part of whatever we've seen as portfolio outflows has been caused by the fact that the carry trade is less attractive now. That is a longer term trend. I don't see interest rates coming back to the same level as they were some time back. So I think, to that extent, the carry trade portion of the money may not return. What is likely, however, to return is the longer term money, which is looking at India as an attractive destination. Because assuming that this experiment of demonetization actually works, even if it works 50%, I think the size of Indian organized economy, as well as the fact that a lot more of it is going through the banking system, will make the growth far more attractive and will attract some of the longer term investors back again.
Okay, thank you, Mr. Tandon, for joining us and simplifying some of that information for us. I hope some of our investors who are watching our news agency have got some clarity as to what they can do. And as for you guys, once again, let's also take a look as to what's happened in the market. For that, we have who will take over and tell us more about the Nifty.
So it was yet another disappointing day of trade today at Dalal Street, where Sensex and Nifty both ended at 6 months below their crucial 26,000 and 8,000 mark. The sell-off was broad-based in nature, and we saw all the sectoral indices ending in red, and even IT sector matter, which saw some gains in the afternoon, lost favor by the end of the trade, and also ended in red. By the end of for Nifty, while Bank Nifty was the major loser with losses of around 2.5%. For Sensex, we saw Realty and Metal Index taking the maximum beating and ending with losses of around 3.5 to 4.5%. So Agam, how do you feel? How was it in FNO Spade?
Well, quite naturally, considering we've seen so much weakness, we are looking at a lot of selling in the Nifty and the Bank Nifty. That said, let's also take a look at what's happened in the options market. Now, if you take a look here, we've seen more selling in the 8,000 call. Now, that is a matter of concern because given the fact that we've seen writing there, it means that a lot of traders are betting against the market moving above the 8,000 mark in the near term. This, of course, can be wiped out again tomorrow if we see a bout of springing back to about the marks of 8,000. But with respect to open interest and the range that we are looking at, now this range has once again shifted even lower, with the maximum open interest in call shifting to 8,200 from 8,500 yesterday. Similarly, while we have seen max OI remain in 8,000, there is more open interest building up in 7,800. So this also means that we are looking at the range shifting lower, and that also shows that there is some concern with respect to traders. But Samit, you're also looking at some critical technical indicators in the Nifty. What can you tell us about the RSI and the 200 DMA?
On the technical side, if you see here today, Nifty has remained below its 200-day moving average of 81405, 5 consecutive trading sessions. On the relative strength index, anything below 30 is considered as oversold position, and if you see here, it's now at 22.5, and it has remained like this for 5 trading sessions. Agam?
Well, in that case, can you also take us through some of the key gainers and the losers with respect to Nifty today?
On Nifty today, the advanced decline ratio was 7:43, while one stock, that was Idea Cellular, remained unchanged today. If you see here, Bharti Infratel was a top gainer with which gained around 2.2%. Then we had Wipro, Tech Mahindra and TCS, who gained in the range of 0.4 to 1% as rupee depreciated today. Reliance Industries and ONGC gained in the range of, gained close to 0.4% as crude oil again gained on the back of optimism that OPEC will cut supply, and Idea Cellular remained unchanged. On the loser side, Bank of Baroda lost close to 9% as the stock saw some profit booking today. Then we had State Bank of India, which lost close to 7%. On auto side, we had Eicher Motors, Tata Motors, Bosch, Maruti Suzuki, Mahindra and Mahindra. Also, we saw IndusInd Bank and Kotak Mahindra Bank here, which lost close to 2.2% and 3.86% after the foreign broking firm Jefferies downgraded the stock to cut from earlier buy rating.
Well, the advance decline ratio in the broader markets also is very discouraging because we have seen one advance for 9 declines. Let's consider the Nifty 500 index, and among them we have gainers in Info Edge India, as you can see here, followed by Infibeam, Dr. Lalpath Labs and Repco Home, along with Crompton Greaves. Each of these counters gaining a little over 3.5 to 4%. But on the losing end, we have seen some substantial weakness yet again. With the Nifty also well below the 8,000 mark, we have seen weakness in Lakshmi Vilas Bank, Sequence Scientific losing out well over 9%. It's the same for Alok Industries, Natco Pharma. Century Textiles also losing out. Remember, just a handful of clients out there hold a substantial amount of open interest in the Century Textile futures. That could be a matter of an issue. OCL India, Intellect Design Arena, as well as India Cement also declining by as much as anywhere between 8 to 9%. So there has been a lot of weakness, and this weakness has continued. But Nikki, tell us more about the money markets and how the rupee has reacted today.
Okay, so rupee started at 68.09 level. It did dip into March 1 lows that is around 68.27 per dollar mark. But however, it recovered ground and we're trading, last seen trading around 68 0.17 per dollar mark. Well, in terms of bond yields, that we can see it is at 2009 lows, which is the 10-year government bond yields have been trading now at 6.33%. So that's about it in terms of currency market and bond.
Well, quite naturally, it was a very, very weak start to the week. And with that respect, we're also going to be keeping an eye on, a few results tomorrow. L&T, of course, will be the biggest result that we'll be watching out for. And other than that, we have IRB Infra. But more importantly, we'll also be keeping an eye on the underlying variables such as turnovers, as well as open interest data, the final print of which will come out in the Bhav copy later on in the day. And that will also determine how trade will move on. For now, turnovers, at least for today, have been relatively lower than as compared to the average of what we've seen in the previous few weeks. But that said, considering the fact that rollovers in this week have been lower, when we are in expiry week, that could be a matter of concern. That also explains that traders are more reluctant for now to take trades and carry them forward to the next series. But for that, you guys will just have to come back tomorrow and join us with yet another edition of Market Wrap. But till then, it's goodbye.